Hello, my name is Randall, and I am here to talk about options with you. I have an interesting trade idea today. Now, it's a trade idea and not a trade recommendation. I don't recommend trades. I'm an options teacher. I'm not a financial advisor. Just the same, I have an interesting idea. Let's look at the VIX, the CBOE Implied Volatility Indicator. Remember, there are two sorts of volatility. There is historical, looking backwards, and there is implied, in which the market, in its collective wisdom of supply and demand, thinks the future volatility will be. And the VIX index measures this. Currently, the VIX is right around 13 and change, with a 52-week range of 1167 to 2191. That's its 52-week range. So you see, it's on the low end of its 52-week range. The VIX is often called a fear index because as people are frightened, implied volatility tends to increase. Also, in down moves in the market, implied volatility tends to increase, and up moves tend to crush implied volatility. I also think the VIX can be called a complacency index, because if no one is afraid of a downtick, implied volatility is low. And I think that's what we're seeing today. Little bit of perspective. When we had all that sequester stuff, government shutdown stuff last September, then was the VIX at its 52-week high. And at the peak of the financial crisis in 2008, the VIX hit 80. So there's a lot of room to run. All we need is one shock, one small black swan flying, and implied volatility could explode. Now, maybe it doesn't. Maybe it doesn't. So I'm going to show you a trade with a good risk-reward ratio. Now, this trade can be looked as a pure speculative play, thinking implied volatility will increase. But it can also be looked at as a downside hedge on your existing stock portfolio. Because if the market goes down, the VIX will go up. So let's look at a simple VIX vertical call spread in June. We have the June 1620 call spread. We can buy it for an 80-cent debit. What does that mean? We can buy the June 16 call at $1.80. We can sell the June 20 call at 90 cents. The spread cannot be worth less than zero, cannot be worth more than $4. So what does that mean concretely? We are risking $80 to potentially make $320. A nice 1-to-4 risk-reward ratio. The most you can lose is $80. The most you can make is $320. I think a lot can happen between now and June. We have the unknown knowns, or the known unknowns, to quote Donald Rumsfeld. Anything can happen, and often anything does. This looks to me to be an interesting trade purely from a risk-reward ratio perspective. Don't forget, a VIX above 20 is not the least bit inconceivable. It was above 20 just last December. So there's my trade idea, not a trade recommendation. I do not have this trade on. I do not talk about positions I have on. That wouldn't exactly be kosher now, would it? This is an idea, a way of thinking about the market that I'm sharing with you today. Thank you. My name is Randall. My website is www.thelissreport.com. I write about options and the market every business day. Thank you for your attention.